The stock market is living on borrowed time. Every single warning sign is screaming crash. Consumer debt at record highs. Corporate valuations in fantasy land. Government drowning in $38 trillion of debt. Yet, here we are, watching the market climb higher every day like it's completely disconnected from reality. I'm Seth, and after decades in fintech and banking, I've discovered something that will shock you. There are exactly 7 forces artificially propping up this market right now. And once you understand what they are, you'll see why the crash everyone's expecting hasn't happened yet, and why that delay is setting us up for something much worse. Let's break down the 7 reasons the market refuses to die. Reason number 7, resilient consumer spending despite all warning signs. Here's what should terrify every investor. Consumer spending is still holding up the entire economy, even though consumers are financially destroyed. Think about this for a second. Personal savings are at near record lows. Credit card balances are at all-time highs. Yet, consumer spending, which makes up 70% of our GDP, is still robust. How is this even possible? It's because people are spending money they don't have at an unprecedented rate. And here's the kicker. As long as consumers keep buying, companies keep reporting decent earnings. Wall Street looks at those earnings and thinks everything's fine. But here's what they're not telling you. This isn't sustainable spending. This is desperation spending. People are maxing out credit cards to maintain their lifestyle because they can't afford not to. They're choosing between paying rent and buying groceries, and they're putting both on credit. The average American now carries over $6,000 in credit card debt. Credit card delinquencies are rising faster than they have since 2009. Yet somehow, this broken consumer is still propping up corporate America. And here's the part that should make you nervous. The moment consumers finally break, and they will break, corporate earnings will collapse overnight. When people stop spending money they don't have, the entire house of cards comes down. But consumer spending is just the beginning. There are 6 more powerful forces keeping this market artificially inflated. Reason number 6, central bank liquidity support systems. Most people have no idea how much the Federal Reserve and global central banks are quietly supporting this market behind the scenes. After 2008, central banks learned something important. Market crashes happen when liquidity dries up, so they built an entire infrastructure designed to prevent that from ever happening again. The Fed now offers multiple liquidity facilities that banks can access at favorable rates. There's the discount window, repo operations, and emergency lending facilities that most people have never heard of. These systems are like a safety net that catches the market before it can truly fall. But here's what's really happening. Banks know they have access to cheap money whenever they need it. This removes the fear that typically causes institutions to pull back during uncertain times. Instead of hoarding cash and preparing for the worst, they keep lending and investing because they know the Fed has their back. Global central banks have coordinated these efforts. When one region shows stress, others step in with currency swaps and liquidity support. It's like having multiple safety nets under the same tightrope walker. And here's the part they don't want you to understand. This artificial liquidity support has removed the natural market correction mechanisms. Markets are supposed to crash when things get overextended. That's how they reset and find fair value. But central banks have essentially disabled that reset button. The problem? This liquidity support creates moral hazard. Banks and investors take bigger risks because they know someone will bail them out. And when everyone's taking bigger risks with artificial support, the eventual crash becomes much more severe. Reason number 5, massive ETF and passive investment flows. Here's a force that's completely reshaping how markets work, and most people don't even realize it's happening. ETF flows reached historic levels with over $1 trillion in flows for the second consecutive year. In 2025 alone, we've seen $1.09 trillion flow into ETFs in just 10 months. That's approaching an entire year's worth of flows in less than a year. But here's why this matters for market crashes. When people invest in index funds and ETFs, that money automatically flows into stocks regardless of market conditions, valuations, or economic fundamentals. Think about it. Every paycheck, millions of Americans contribute to their 401k. That money gets automatically invested in index funds. Those index funds have to buy stocks, whether stocks are cheap or expensive, whether the economy is strong or weak, whether a crash is coming or not. This creates constant automatic buying pressure that has nothing to do with market fundamentals. It's like having a conveyor belt that never stops feeding money into the stock market. And here's the scary part. Passive investing now represents over 50% of all stock market investments. That means more than half of all stock buying decisions are made by algorithms, not humans analyzing whether stocks are actually worth buying. This passive flow has created what some analysts call price-insensitive buying. The money keeps flowing in whether stocks are fairly valued or completely overpriced. And as long as people keep getting paychecks and contributing to retirement accounts, this artificial buying pressure continues. But what happens when people stop contributing? What happens during a recession when people start withdrawing from their retirement accounts instead of contributing? That conveyor belt suddenly reverses direction, and all that automatic buying becomes automatic selling. Reason number 4. Corporate share buybacks are creating artificial demand. This next reason should make every investor question what they think they know about stock market returns. S&P 500 companies spent a record $942.5 billion on buybacks in 2024. But 2025 is on track for something even more insane, $1.1 to $1.35 trillion in buybacks. That's the fastest pace on record. Here's what this means in simple terms. Companies are using their cash and borrowed money to buy their own stock. This creates artificial demand that pushes prices higher, even when there's no real economic reason for stocks to rise. And here's the number that will shock you. Buybacks have accounted for 27% of S&P 500 returns over the past decade. Analysis suggests that without buybacks, the stock market would be roughly 30% lower today. Let me repeat that. The stock market would be 30% lower if companies weren't artificially inflating their own stock prices. But here's the part that should terrify you. Companies are funding these buybacks with debt. They're borrowing money at historically low rates to buy their own stock. This works great when interest rates are low and stock prices keep rising. But what happens when rates rise or stock prices start falling? Companies get stuck with massive debt loads and overpriced stock that they bought at the top. And when companies are drowning in debt, they can't invest in growth, they can't hire workers, and they can't weather economic storms. We're essentially watching companies hollow themselves out financially to create the illusion of stock market growth. And Wall Street loves it because it makes their portfolios look better in the short term. But artificial demand always ends. And when it does, prices snap back to reality fast. Reason number 3. The AI boom is propping up everything. Here's the force that's single-handedly carrying the entire stock market, and it's more concentrated and dangerous than most people realize. AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched. Let me say that again. 90% of capital spending growth is coming from AI. AI capital expenditures now represent 1.1% of GDP growth. That means AI spending has actually surpassed consumer spending as an economic driver. Nearly 2/3 of all U.S. deal value in 2025 went to AI and machine learning startups. But here's what this really means. A handful of AI companies are essentially carrying the entire stock market on their backs. Remove AI stocks from the S&P 500, and the market would look completely different. And here's the part that should make you nervous. This AI boom is built on promises, not profits. Most AI companies are burning through cash at incredible rates while promising revolutionary returns that may or may not materialize. We've seen this movie before. In 1999, internet companies were going to change everything. Investors threw money at anything with .com in the name. Companies with no profits and no clear path to profitability were valued at billions of dollars. Sound familiar? The AI boom has created the same kind of speculative frenzy. Companies are adding AI to their business descriptions and watching their stock prices double overnight. Investors are paying insane multiples for companies that might not exist in 5 years. But here's the really dangerous part. Because AI stocks are such a large portion of market returns, when the AI bubble finally pops, it won't just hurt tech stocks. It will drag down the entire market. And bubbles always pop. Always. The only question is when. Reason number 2. Dollar devaluation and inflation are disguising weakness as strength. This is where things get really sneaky, and it's something most investors completely miss. The current administration wants to see a weaker dollar to make our exports cheaper. That's no secret. But other less obvious factors are working to decrease demand for the dollar. First, BRICS countries led by China want international transactions settled in currencies other than dollars, and it's happening at an accelerating rate. When demand for dollars decreases, the value of the dollar also decreases. Second, U.S. Treasuries are no longer seen as the risk-free, flight-to-safety assets they once were. That also decreases demand for the dollar. When the government floods the system with dollars, inflation and dollar devaluation accelerate. You have more dollars chasing the same goods and services, which causes prices to rise. And when the supply of anything increases, the value of that thing goes down. So every dollar you have is silently bleeding value, even if your bank account balance hasn't changed. But here's how this props up the stock market, and this is the part most people never understand. When the dollar loses value, companies can raise prices. When prices rise, corporate earnings rise, not because they've become more innovative or productive, but simply because the dollar doesn't buy as much anymore. This is why companies can report record earnings even when fewer people are buying their products. It's not growth, it's inflation disguised as growth. But Wall Street doesn't care. Earnings go up, stock prices go up. And here's the kicker. If you borrow money to buy assets like stocks and inflation rises, two things happen. Your debt becomes cheaper because you pay it back with less valuable dollars. Your asset values increase because replacement costs rise. Big investors like hedge funds are borrowing large sums of money to buy stocks. If inflation stays high, they win big. But here's what they don't want you to know. Inflation works in favor of people who buy assets with debt while destroying everyone else. The top 10% own almost 90% of all stocks. So, as inflation and dollar devaluation take hold, the rich get richer while the bottom 90% see their cost of living rise and their dollars stretch less and less. Reason number 1, the government keeps stimulating demand, quietly. Here's the biggest force propping up this market, and it's happening right under everyone's nose. Officially, stimulus checks ended years ago, but the government is still injecting money into the system in ways the average person never sees. Look at the numbers. The government collects about $5 trillion every year in tax revenue and spends about $7 trillion. That extra $2 trillion has to go somewhere. Much of it finds its way to companies through expanded credit programs, corporate support mechanisms, and what some people call corporate welfare. Companies get this money, pay employees, employees buy things, corporate profits rise. It's stimulus wearing a disguise because they don't want you to see it. But here's the part that should terrify you. We now have $38 trillion in national debt with annual interest costs of more than $1 trillion. How long do you think the government can keep spending $2 trillion more than it collects before we have a reckoning? And here's what most people don't realize. When the government boosts demand, even indirectly, stocks stay inflated longer than they should. But this creates a dangerous feedback loop. The more the government spends to prop up the economy, the more debt it accumulates. The more debt it accumulates, the more it has to spend on interest payments. The more it spends on interest, the less it has available for everything else. We're rapidly approaching a point where interest payments alone will consume most of the government's tax revenue. When that happens, the government will face a choice: default on its debt or print money to pay the bills. Either choice destroys confidence in the dollar and triggers the very crash these policies are designed to prevent. Why this crash will be different. Here's what makes this situation more dangerous than previous market bubbles. We don't just have one artificial support system. We have 7 of them all working together. In previous crashes, maybe 1 or 2 support systems would fail and the market would correct. But this time, we have consumer spending propped up by debt, central bank liquidity facilities, passive investment flows, corporate buybacks, AI speculation, currency devaluation, and government stimulus all working simultaneously to prevent any natural market correction. The problem with artificial support systems is that they don't eliminate risk, they concentrate it. Every day these systems prevent a natural correction. Pressure builds up behind the dam. And here's the part that should keep you awake at night. When artificial support systems fail, they don't fail gradually. They fail all at once. Think of it like a dam holding back water. Small cracks appear, but the dam holds. More pressure builds up. More cracks appear. The dam still holds. But eventually, one final crack appears in the wrong place, and the entire dam collapses in minutes. That's what's happening to our market right now. We have 7 different systems all working to hold back the natural forces of market correction, but each system is showing cracks. Consumer debt can't rise forever. Central bank support has limits. ETF flows can reverse. Companies can't buy back stock indefinitely. The AI bubble will pop. Currency devaluation has consequences. Government spending has limits. When these systems start failing, and they will fail, the crash won't be gradual. It will be sudden, severe, and shocking to everyone who thought these artificial supports would last forever. What this means for you. The market hasn't crashed yet, not because the economy is strong, but because 7 artificial forces are propping it up. Understanding this gives you a massive advantage. First, don't mistake delay for safety. The longer a crash is delayed by artificial means, the more severe it becomes when it finally arrives. Second, prepare for the crash to happen faster than anyone expects. When artificial support systems fail, they fail quickly. Third, position yourself to benefit from the crash rather than be destroyed by it. The same forces creating this bubble will create incredible opportunities for those who understand what's really happening. The crash isn't canceled, it's cued, and the 7 forces holding it back are weakening every day. If this breakdown helped you see through the illusion, hit that subscribe button and ring the notification bell. We publish fresh, no-nonsense content every week to help you navigate these dangerous markets. And if you want to learn how to position yourself for what's coming next, check out my video, How to Get Rich During the Next Market Crash. It's linked in the description and on your screen right now. The crash is coming. The only question is whether you'll be ready for it.